Welcome YouTube family, get ready for a game changer, another episode introducing Market Bullets, your ultimate series on stocks, investing and all things finance. Whether you are pro or just starting, we've got insights, trends and expert advice for everyone. So don't hesitate to subscribe, hit the bell and join us in this journey into the heart of the financial world. So I'm very glad you said it to pop in, and we are just jumping right to the first element. And today we are just spreading everything across the board. The board that will be just let me just make it out. So the board that will be just divided into economy, then stock market, crypto, investing hints, and hot pick. That's NIO for today. So at first, let's head on to elements related to economy. So ISM Purchasing Managers Index from United States, the one that has really shocked the market as it expected to this one to thrive. Right now, we are in the second month at the same level below 50, so it means that we are right now still in a contraction phase. Back in September, we had some hope, some appetite for making it going through the roof, right to the levels that have been yet seen previously back in 2021 when we had this outstanding bull market. Right now there is no really golden path for the economy, and with ISM manufacturing PMIs we are right now a laggards. Right then, let's jump to another findings that I wanted to just point out that are also crucial to comprehend. Financial conditions loose enough to make Fed threat, and it means that right now the Fed is interested in cutting rates. We don't know yet when it will be proceed, but with worsening data out of the economy, as we said, the PMIs and also US financial conditions overall, we can find that Fed may not be so keen on to make this step towards cutting rates. Right now we are holding a kind of a pivotal moment for the markets, and everyone is almost at the very sitting and approaching of the sideline type of a measurement. So right now there is not maybe anything so alarming to see, but what I do find is that the Fed might be considering postponing the rate cuts even for some other time and then the first quarter of the next year that is supposed by some analysts. So financial conditions are swinging, gauging that there are some also engaging that are contracting, and right now we are rapidly moving toward the environment where supposedly we may have this rate cuts, but still there are few options to get through, whether there will be first quarter or the second, that will still it's about to find out. In terms of reverse impulse for stocks right now, could we get this in a moment? We are awaiting for the Fed rate cuts in order to push the stocks higher, at least in the short term. Right now, however, many market funds effectively supporting the fiscal deficit by acquiring T-bills, and the government withdrawing funds from the Treasury's account at the Federal Reserve. So it all leading to an upswing in both stock and both markets. But how long it could go? How long can it thrive? Right now we are in a very good seasonality for the stocks, and that may pose a better performance for them. But with the January coming up, this sentiment may fade away, and this expansion also are expected to slow down. Right here you have financial conditions, and that what I just said is pointing that we are more into the loser environment, at least in this fourth quarter. So normally the tendency right here from March 2020 is rising in terms of tightening, and I don't expect this one to just collide through this level, and I would find that there is more analysts more confident about kind of a rebound and maybe moving up even higher. So that's yet to get find out. Right now, let's jump to another element, and that's what do we got here? So consumer confidence index actual level versus what we could expect based on economic indicators. And look at the US. US is the outstander with the very low expectations on the economy. So consumer is much more tilted to the downside, but the economy shouldn't really perform that well. That's what analysts are finding. So Americans consistently hold pessimistic views on nearly every measure the analysts examined, and they mistakenly believe on nearly every measure right there. So that brings us to the fact that you should really break down the hard data, not only suggest yourself by and really bias yourself by what the neighbor is saying about the economy in order to make the financial decisions. That's why that's very good that you're watching Wall Street Station Market Bullets. So if you enjoy, just hit this like button. All right, we are jumping to stock market, and let's find out in terms of Nasdaq as of 23rd of November. No, it's the most up-to-date data. Anyway, there is no description this underneath the chart, so you can have right here the findings that the Nasdaq is about to get traded at where the positivity is right back on track. So it means that at this inflection points that we are right sitting here, it's very important where this positioning is tilted towards. As right now we are on the upside, and normally the market moves on the other direction. At the inflection points, the majority of crowd is wrong, and that's not somewhat surprising that we may have a correction right here after such a great move up. In terms of another element, percentage of large cap domestic equity funds underperforming the S&P 500 each year is outstanding at 60% this time. However, when it was at the downside move, the most of the, so I would say the lesser of hedge funds were positioned well because they played for recessionary scenario. But back in 2021, when we had this giganormous rise on the stock market, we had 85% of the hedge funds being wrong on the market. So that's why you need to think twice of really having your money being possessed by any of the hedge funds, as normally they are over-biased to the downside or to the upside, and that sparking the problems along the road. Another thing that I wanted to just pose out is the composition of treasury bond net buying, and we can find it right now. We are in the scenario where around 73% of market participants that are just loaded into this treasury bond, the market is kind coming out of the households. So households are believing and also preparing for the bad times to come. So it means that when we are normally just holding such a strong position on treasury bonds, it usually comes out to the fact that we are so scared that the economy doesn't eventually crash. So I don't expect the recession out of this gauge to occur somewhere in the vicinity, but it may happen somewhere in the second quarter of or second half of 2024 or maybe 2025. So it's still many time ahead. A lot of aspects been gone through yet to just finding a possible deterioration in this economy gauges. At least by this gauge, I don't expect the Armageddon as to happen right now. Okay, so what we got here: average S&P 500 returns around a recessionary bear market since 1871. So after the curve steepens, credit tightens, and first Fed cut takes place, normally by history we were going downturns, and this period is still around 12 months from where we are from a supposed recession. So it may add up to the fact that the recession may occur somewhere in the 2024. So when it comes to the market sentiment, we might be sitting somewhere at the denial or anxiety, somewhere around the dead cat bounce that may eventually lead us to capitulation and despondency. So you have your seatbelts have fastened in order to survive throughout these murky waters. So the first cut is typically never the bottom of the market, and it's hard to suggest that a bear market reaches its bottom when the S&P 500 trades at 25 times earnings as it's right now. All right, so we are jumping to crypto. We should have a good time for crypto overall in this 2024 year. This quarter is the harbinger of what may come next. So we have a great influx, and one of the sectors that is really performing well on this influx is the gaming on blockchain. So those are the names, those are literally the tickers that are performing outstandingly fine. So the most robust sector has recently been this gaming one, and the metaverse as well. So essentially all of the tokens showed comparable performance to BTC during the initial surge of the ETF fueled rally in October. So if you are interested in that fact, you may just find out those tickers on CoinGecko. That's the website to track the coins. All right, so we are right now jumping to next thing, and that's investing hints. So let's start from scratch. 30 year versus 1 year returns. That's the very nice finding. In this year we have outstandingly well performance, but still 1 year doesn't bring a total way on your, or shouldn't weigh totally on your investment. So think long term as in order to compound your profits. In order to really get this affluence, you need to compound your profits. So 1 year returns can make you feel wonderful or terrible, but they not going to have a ton of bearing on your long-term results, and just remember this one. So however, as a conclusion as well, I wanted just to post that after such of a very nice, very positive year, I would say, after the downturn, normally we are going through another positive year in the year to come. So 2024 should be overall positive based on what history tells. All right, so we are jumping to next one, and to savings as share of income. That's right here, posing that if you want to be kind of a market wizard that really have gained on the market large portion of money, you need to really have your paychecks higher in order to save more and then risk possibly on the market sequentially higher. So you can find that alternative for the type of a attitude is to become a trader supposedly and then compound your profits over the long run. But if you don't have so much time for trading, I do find that this kind of a approach, when you are just having your wage greater and then compounding your savings on the market, is the one of the greatest way to become an affluent person. So don't hesitate to ask for a rise. In terms of the households that saw the greatest impact from stimulus, we could find that the stimulus impacted the most the poorest households. But if you just find out that not maybe been seen so much at this graphic, but those households that risen its state of well-being after stimulus hasn't really managed to preserve the capital and then lost it possibly within 2 or 3 years after the pandemic took out. So it means that normally you need to really invest in the education in order to find out the greater results on the market. Otherwise, you should just away from investing anyway, because unfortunately you may lose it all. Right here you have a 20-year annualized returns by asset class, and in 20 years this average investor is underperforming the market substantially. So that's why you need to get very cautious in investment. That's another example why. All right, so we are jumping to the last theme of today, hot pick. It's NIO. So NIO is after its earnings reports, and let's find out very quickly. Earnings per share is right now somewhat better because it's a negative territory, and revenue is also increasing, so we should have eventually rebound in the market. NIO has performed very badly during this fourth quarter, and after the second quarter bounce, we may have another rally upwards, but about it in a second. In terms of the projections, that's the projection that didn't really counter up this latest earnings one, so it may be a little bit downside tilted, but overall tendency right here is that in 2024 earnings revenue has downwardly been skewed. So it means that this one report is the ray of hope for NIO investors and the stock that may eventually meander along into a more positive currents. Another thing I wanted to highlight is after this fundamentals, the chart itself. So we are right now going through a double bottom pattern. So it means that's one of the strongest pattern, rebounding pattern. If it also coincides with any type of a reversal pattern or candlesticks, so any type of a engulfing or piercing pattern, we may have a nice rally at first to $9 and afterwards to 11. So I do expect supposedly to such rally ahead. In terms of daily, we also have kind of a rebound but it may take a while, and I wouldn't really jump on this bandwagon before crossing this 8 bucks level and consolidating within this area. So right now it's still catching the falling knife, and we don't like that. So that's it in today's episode. Thank you very much for watching. Let me know whether you have enjoyed, whether you have just found something interesting, and we are seeing each other tomorrow. Oh, sorry, not even tomorrow, but today we are catching up with another episode of